The number one question I get asked from all traders is to understand the difference between a break of structure and an inducement, because in hindsight it's very easy to understand the difference, but in live market conditions it's actually very challenging to determine what is an inducement and what is a market structure movement, specifically a break of structure. And a few years ago I was struggling with this myself too, because an inducement and a break of structure are seemingly very similar, but they have completely different outcomes. So at times when I could not correctly identify it, I would be trading on the wrong side of the market. So the journey I went on that took me from a profitable trader to a vastly profitable trader was truly understanding the nuances of an inducement and mechanical objective differences between market structure and inducements to really differentiate how liquidity can lead the market and how market structure can support it. For the last 7 months, I've been giving each one of my trades live ahead of time as free public signals, and in documenting over 60 signals and showing over 55% gain. What this 7-month project has shown is the power of M1 mastery, the daily cycle, and more importantly, the power of inducements, because each one of these 60 trades is because of time-based manipulations and reading market structure correctly. So this video is going to be imperative for any trader to really succeed, and I'm going to show you the exact difference on how you can identify the difference between a BOS and an inducement. So from today, you can start utilizing this in your own trading. So here we can see a simple example of a bearish market, and that's obviously denoted by a series of lower highs and lower lows. Now, when you have a market that is forming a series of lower highs and lower lows, the natural thing that you should be looking to do is trading the complex pullback if it confirms, knowing it's a counter trend trade, and these are going to be utilizing intra-session volatility specifically. And then when you come to the major points of interest, for example, supply zones, that's when you'll start to look for confirmations on a lower time frame, daily cycle variance, inducements in your direction to then fuel a move lower. So that's simple market structure trading. Obviously, this can get a little bit more advanced when you start to understand the differentiators between what is a complex pullback versus what is a actual trend move. For example, you could say this area over here had a bearish break of structure and made a lower low. So why are we not looking to sell and make lower lows from here? Well, you have to understand that we are in a complex pullback, and there's going to be all kinds of rules that confirm what is a complex pullback, what is a main trend move, what is the beginning of the main trend, what is the completion of a complex pullback, and also correctly identifying points of interest. For example, once you've established a complex pullback, you can start to buy on these internal price action points. You buy the higher highs and higher lows, the internal trend, all the way up to supply points. So we know that these higher lows that made higher highs can be valid demand areas pro trend that you look to buy upon. But you have to also understand these demand areas can all become liquidity and therefore not valid POIs the moment the bearish market begins. So therefore, if we are caught buying on these various demand areas when we know that the bearish market has started and we are going to make a new lower low, then we are going to be trading the wrong direction. We are going to be trading what is actually liquidity. So there's multiple ways to solve this, where you have a deep understanding of market structure, where you have a full understanding on what validates a POI, what makes a strong point of interest, and also when these seemingly strong points of interest become invalid and also become counter trend. So these are separate guides that are made on this channel, and this is going to be complete market structure understanding, and this will take you to a very strong level. This will even take you to a profitable level. But what really sets traders apart is utilizing inducements on top of this, because inducements never lie. Runs of liquidity never lie, because liquidity is the fuel of the market. And I've made videos on this channel where I speak about what you do when market structure is neutralized, when smart money concepts is neutralized. The only thing you can do is understand inducements and use it to your advantage. So how can we utilize inducements to not only complement market structure, but also to reveal the weaknesses of market structure and not take losses? So the key point I want to mention here is, imagine we're entering a demand area over here. Now that's not something that is out of the ordinary, because all of these levels could be hitting demand areas, and hitting a demand area is not an exact requirement that you have to make a higher high and switch trend, because we know that certain demand areas can just be reaction points. For example, price comes in over here, gives a reaction, and then goes on to make a small bullish move to fulfill the complex pullback, and then breaks that demand area and goes to the next area. So market structure is always going to be going from zone to zone, from POI to POI, and we have to understand multi-time frame trend analysis to know what's going to sustain. So in this case, you imagine you are entering a demand area, and we know that we can have a potential reaction to come to a supply point and then eventually go on and make a lower low, or we could have potentially price coming higher, giving a small reaction, building an internal trend to do a complex pullback to another supply point before coming lower. That is another possibility. The other possibility is this demand area is the most powerful demand area. This bearish trend has ran out of fuel, ran out of momentum, because sellers have started to take profit as the market comes lower and lower, and buyers are starting to enter the market because we are in discounts, price is cheaper. So with that interaction, new market conditions, maybe we start to begin a new bullish market, and therefore we establish a new bullish trend. So then you would say, okay, market structure shifted and now we start to look for buys, and maybe any losses you took on this supply level, you just say it's part of the game. But that's not the truth, because all of these conditions that I've mentioned, whether it's a new trend, whether it's a complex pullback, whether it's a grab of liquidity of this point to come to the next supply level before we come lower, and therefore this move over here is all just temporary. We need to know how to navigate that. We need to know the telltale signs, the digital footprints and the signatures in price action that will reveal the differences. We should not be a victim to the market. We should not just say, oh, it is what it is, better lucks next time. We should learn. We should read price action. And if you're only reading the daily time frame, you will never get it. If you're only relying on the 1 hour and the 15-minute time frame, again, you'll probably never get it. But if you can start to read intra-session time frames, M5, M1, understand time-based manipulations, understand the purpose of inducements, understand the correct liquidity pools that are resting in the market, understanding the traps the market builds. Because if you're a non-believer of this, just go and look how support and resistance levels get induced. Just go and look how trend lines get induced. Just go and look how break and retest traders get induced. In fact, I have exact trade model on this channel, a 70% win rate trade model that I've used to make millions of dollars myself, that is exactly relying on the inducements of smart money traders and the inducements of support and resistance traders. I gave a step-by-step checklist of that exact trade model. Manipulations happen all the time. Traps happen all the time. And the way traps work is the market engineers a liquidity pool, entices people to get in, and then induces them out by grabbing their stop loss. It's a case of showing a narrative and then taking it away. So in this video, I'm not going to make a full guide and show case study after case study. You're going to have to do some research on the channel because all of the information is here. But if you want me to go through and backtest multiple examples and make a full case study and guide, going through example after example, do let me know in the comments below. But right now, I'm just going to explain theory. Now, in theory, let's say we start to have an accumulation schematic. Now, you should just know Wyckoff theory and you should start to understand how that starts to look like. So you'll have inducements to the high, for example, like this, where we have a buildup of a resistance level. And then we get to this potential bullish breakout. So what is that going to do? That's going to invite buyers into the market that see this market structure shift on the lower time frame. Well, we know that in an accumulation schematic, you will get inducements to the high and low. And when you get something like this happening, you will see that the market took the liquidity of that resistance level, took the liquidity of this trend line, and this overall horizontal price action, not actually a trend. This is how an accumulation schematic is, and this is where the sellers exit, the buyers enter, and we accumulate orders before a significant expansion. That expansion can be to a supply zone or a new trend. So when we are seeing this forming, the name of the game in an accumulation is the spring. That spring, in other words, is a inducement. So when we see these signatures and we get a valid inducement, we know that we are establishing a complex pullback. So this complex pullback, we will just look for certain demand areas and you say, okay, I've established the market has shifted from bearish price action, from lower highs and lower lows to forming a break of structure and higher highs and higher lows. So when you are forming that shift in trend, you just need to know where that complex pullback is going to terminate, and therefore you find validated supply areas, and you know that from that supply area you should anticipate a new bearish trend. So until then, you can be bullish and then you can look to buy. And you can say, okay, these kind of areas I look to buy to make higher highs. And then you'll have not only extreme points within market structure, that is going to be the origination point of a push, of an expansion, but you're also going to have other types of POIs, the ones that led to the break of structure, for example, a decisional. So when you have all these kind of POIs, you can be sure to say, okay, I'm going to start trading these areas, looking for buys until I arrive to my supply point, and then I'm going to shift my bias and look for sells. So all well and good. But what was the key to this? The key to this was not this demand area. The key to this was understanding market structure shift, where we had the lower high that made a lower low, but more importantly, how we had indecision, fails to make a higher high, indecision fails to make a lower low, and then goes on to make an internal higher high, internal higher low, internal higher high. So what is that? That's just simply a trend. That's just simply seeing bullish market structure inside of a bearish leg, and you'll look to trade that complex pullback and then establish a new trend. Now, the telltale sign of this, for someone that's a little bit more advanced, is starting to understand how the market started to round off. We started to have that accumulation schematic, and more importantly, we had this inducement. This inducement was the fuel that allowed the bullish expansion to form. So the inducement is always going to be the fuel, and we can see, I mean, this is just a diagram, but you'll see this in real price action where you get inducements fueling moves. You get a buildup of liquidity, inducement to fuel a move. Same again, a trend line, inducement, and fueling a move. So this is signatures you'll see in price action. You've seen countless examples of me do this. This is not my opinion. This is a fact. So when you see these kind of things, you have to understand how to correctly identify this leading indicator, which is inducements, because that's going to be telling you the law of cause and effect. If you have a cause, which is the market induced, it grabbed liquidity, it grabbed this fuel, it has new orders and new participants and new conditions. When you have this injection of liquidity, you have to see a reaction. You have to see market go bullish. If you have a bearish inducement, the market should follow through. So what are the signatures of this? I like to condense it down to a few that do not ever lie, that are reliable, and that is going to be in line with wisdom of the law of cause and effect. So if you get a cause and a catalyst, which is a inducement of liquidity in the demand area, we have now got an injection of buyers and the early buyers getting taken out, sellers getting taken out, manipulation of break retest traders, all of these things that an inducement holds, especially if this is on a time window. But this would be one major way to differentiate between fake outs and real moves is going to be time. Let's say a London Open, that's going to be a strong one. But what's going to be better is understanding the follow through, understanding that this inducement should lead to three things. Breaks of structure. We should see a follow through that leads to internal breaks of structure and starting this bullish trend that we see of higher highs and higher lows. If an inducement happens and we don't see market structure shift on a lower time frame, that inducement is not real. It's just a bearish break of structure. Another one will be imbalances. If you can see the market leaves strong bullish candles that are leaving imbalances. Imbalances showing disequilibrium and the market is showing momentum to one side. And if we are getting imbalances and not wicks closing, those wicks closing is essentially on a lower time frame, retracements. So if you're getting a lack of retracements because you're getting strong bullish price action, large bullish imbalances, that is a signature of strength. That is a signature that inducement has led to a market condition that is strong towards the buyers. And lastly, we have to look at momentum. If the retracement is taking 20 candles and then the impulse is taking 3 candles, that is a sign that we have strength towards the impulse. So if we get a seeming inducement and then slow, consolidative, choppy price action, that is not a good sign. But if you get an inducement and then price rockets with large imbalances, large momentum, and bullish breaks of structure, and then you add in time, you can rest assured that you had a correct inducement. So when you start to utilize these things to supplement and validate your inducements, then you have a signature to know where the direction is going. The market is going to go to the next POI or the next liquidity pool, and that's going to be fueled by the inducements. So let's say you have a market structure condition where we have a bearish trend and then it's starting to consolidate. So then you say, okay, with this consolidation, I don't know what to do. So I say I take my supply zone, and I know price needs to go on to continue to make lower lows. So let's say you have a market condition like this where you have a bearish market structure and then you have zones of liquidity and consolidation over here. So you know that if price starts to come higher, tap into this supply zone and go on to make a lower low, that would be the most logical thing. Or price could just go on and see this resistance and then go on to make a lower low. So that's the trend. That is the trend speaking. Now, if price starts to come higher, tapping into this area, how do we know that price is not going to continue higher? We verify the POI and we verify the reaction. What happens if price starts to come higher and starts to come over here? How can we say that this is not an internal high and an internal higher low, an internal higher high, and therefore we should come higher like this to the next supply zone? All these questions come because we cannot correctly identify the difference between an inducement and a market structure break. So for example, if we get a price coming lower, what are people going to see? They're going to see this was a market structure break, and they will look to sell like this. Why will they look to sell? Because they see bearish break of structure from the last structural point that was holding price, like so, and then they look for the nearest supply zone that led to that break of structure. And that's a logical thing to do. So if you're trading market structure like such, where you get a resistance level and then a bearish break, you will lose out in a situation where this goes on to do an inducement and come higher. And that's based on the fact that we had a liquidity pool right here, an inducement of that stop loss, and these were the fuel to come higher. So to verify these two roadmaps where the confusion is right here, because this looks like a bearish break of structure and therefore you sell, but it could also be an inducement and therefore you look to buy. So the reality is you have to fall back on these three things. I'll make other videos if you want to show case studies and examples of multiple time frames and complex examples to really solidify this. But after this video, I want you to go and backtest this. When you have zones where it looks like a bearish break of structure, but then market goes bullish, those areas where you think market structure and inducement looks confusing, investigate it on the M1 time frame and look for the three things of bullish break of structure in a lower time frame, bullish strong momentum, and large imbalances on a time window. Those three things will lead to correctly identifying inducements and therefore knowing the difference between an inducement to fuel a move higher versus inducements along the way to know if a POI is going to break. And that's going to be correctly understanding inducements and therefore looking to buy, as opposed to seeing the market has come to a supply zone and given a bearish break of structure like this and taken out that level. Key information, but these are the ways you'll validate it. Momentum, bullish break of structure, imbalances in time, these things will not lie. So if you see a bearish break of structure and then these three things, instead of looking to sell, be cautious and maybe even look to buy. And therefore the mantra of this channel, as always, a restricted trader is a profitable trader.